Thank you. Welcome, everyone. Over the past 5 years, private credit has grown into a $2 trillion market. It's 10 times larger than it was in 2009, and it's projected to reach somewhere between 2.8 trillion and 3.5 trillion by 2028, depending on which sources you consider to be most accurate. Today, we're going to explore why private credit continues to thrive, and we'll alternate between our distinguished speakers. I'm Ellie Saffron. I run an advisory firm here. I've lived in Abu Dhabi 17 years, and we help companies and funds connect with this part of the world. And here we have over $300 billion of private credit managers to talk to about this topic. I'll kick off with Lawrence from Golub Capital, a $70 billion private credit fund. Golub Capital is celebrating its 30th anniversary this year.
That's right.
30 years, which means you have experienced the rapid growth of private credit and perhaps driven most of that over that time. Could you take us back to the early days of private credit and discuss its evolution to where we are today and where you are?
Delighted to. So I started the business in 1994, and at that time, banks were really starting to struggle with senior debt, but there was a very developed subordinated debt market and just an incipient market of non-bank lenders developing. We really had our growth take off in the early aughts and mid-aughts as we developed the one-stop loan product, which was very valuable to private equity firms as they were buying businesses because it was simpler, higher certainty, better partnership, better alignment of interest. And something that private credit, when done right, brings to both the investor and to the borrowers is this better solution. It's not just a cheaper form of money or a more expensive form of money, depending on which side you are. And it's about designing a business, designing competitive advantages that really address needs that each client base has. And as private credit has grown, with private equity in the case of direct lending, which is what we do, direct lending has grown in its capacity to do larger and larger transactions. So direct lending has grown with the size of the private equity industry, but it's also grown taking over more and more of the capital structure.
Great. And we actually have a bank on the panel today, so we'll be touching on that in a little while as well. So some investors perceive private credit to be risky and carries a lot of default risk, when in fact you can generate equity-like returns with a lot less risk than equity in some cases as well. How do you guys protect yourself from losses, and what are your thoughts on that?
Well, I think the lending business is hard. Actually, making loans is easy. Getting paid back is hard. And there's an inherent conflict between our private equity partners who want less expensive, lower documentation, easy terms, and our investors who want alignment of interest, higher returns, and above all else, resiliency. So we've addressed that through specialization. We are the best, we aim to be the best in sponsor finance. We're very specialized, even though we now have over 70 billion of loans outstanding. Of the scale U.S. direct lenders, we are by far the most specialized. So for private equity firms, we don't charge extra for our reliability and our partnership, but we are more selective. And for our investors, being more selective and being focused in certain industry sectors, having the alignment of interest of ourselves, having a great deal of money invested in the funds, provides steady returns. So we're trying to deliver premium returns, which we've done, but also with resiliency across all the different crises that come up every 6 or 7 years.
Okay, great. And Volkan from Vibrant Capital Partners, you sort of focus on both private credit and broadly syndicated credit. What are your views on private credit and being a risky investment and the areas of growth?
Yeah. Thank you very much. This is the third Abu Dhabi Finance Week. I'm proud to be 3 years in a row part of it with very distinguished speakers. I think both private credit and broadly syndicated credit spaces are growing. Private credit is growing very fast due to demand. The last 3 years I'm observing everyone is talking about private credit. Everyone wants private credit. Why? I think we should a little bit touch upon that. When you are in a actively traded, priced every day, broadly syndicated credit, day-to-day risks of the economy, etc., reflects to the price. So you get volatility. So institutional investor looks at it and says like, well, if I'm going to invest into credit, I'm going to get so much volatility like equity markets. Why don't I just invest into equity markets if I will experience this volatility? So most of the investors that I see, they do not want to have this volatility in credit space. They just want the income and relatively stable pricing. Private credit, as you know, is illiquid, it doesn't trade. So the price, day-to-day volatility, doesn't reflect to its price. This has driven a lot of the demand to this area. But I do want to say that private credit or public credit, it's the same economy, it's the same companies. So therefore, I do think we should be careful when we are allocating, very, very aggressively to private credit. I do see the next couple of years continued growth, both in private and broadly syndicated space, but I do see a little bit, due to this excessive demand, problems slowly appearing. When demand peaks in a certain area, in general, underwriting standards starts loosening up. I don't see that becoming a problem the next 2 years, but maybe 2027. In the same panel, we might start talking about some serious problems.
Mm-hmm. Thank you. And Ron, Daniel, you're the founder of Liquidity Group. You're a double disruptor in a sense. You're in private credit, but also using AI and technology to create something really unique in that area. Can you tell us a little bit about that? And also talk about how AI is working within this space and what you're doing with that.
Sure. So I'll begin with the fact that AI is on the way of being a good tool to make decisions on finance, but it's not yet there. I would more say it's machine learning algorithm that you have to perfect and perfect again, and then you can translate it to something human being can understand through AI. So AI is still a buzzword, but we are getting there. And I think Mr. Gomez here said they are highly specialized. Even there are $70 billion asset managers. And I think in this sentence, you see the exact challenge of private credit, because it's getting harder and harder to get the right decision at scale, right? It's one thing when you need to get 100 decisions a year, completely different things when you need to get 10,000 decisions a year, which are not statistical. When you want to deploy a lot of capital fast, you need to be able to sustain a level of decision science, and you don't have enough expert in the market to do that. So the only way to bridge this gap, which is growing, is through technology. That's what we're doing in Liquidity. It's a step-by-step effort. We deploy based on our technology, and we expand the scope of what the technology can monitor and do diligence.
Great, thank you. And last but not least, Borja, you're from Santander Asset Management, and Santander has a unique position in private credit given the global banking roots. How do you view the role of banks as originators compared to the trend of disintermediation in the private credit markets? We've got market shares in the US and Europe of private credit somewhere between 35 and 50%. In Australia, it's a lot less. It's only 15% at the moment. But where do you see the role of banks in addition to the role of Santander in the shift? And do you think that banks will start to claw back some market share? Or how do you view the outlook?
Thank you for the question, and thank you for having me. Look, I think when we talk about private credit, we need to put numbers into perspective, no? You've mentioned a few percentages, but also, let's face it, that private credit is around a 2 or 3 trillion market, no? The biggest banks are 100 trillion of balance sheet among them. So there's a huge space within the private market dominated by banks, no? And now we're seeing how different asset managers are joint venturing with private market players in order to get access to that origination that banks have, no? And the banks have an excellent origination capacity and excellent relationships that have lasted for decades, if not even centuries, that now asset managers are trying to get into. And there are different ways in where they're getting into. Some ways are just doing joint ventures for originating directly the loans to the banks, and others are instruments that are in the market that the regulators have approved, like the synthetic risk transfers, which asset managers can buy, getting access to pools of credit risk within the banks whilst leaving the origination and the day-to-day management of those loans with the banks at what they do best.
Thanks. Ron, your firm has invested in 35 countries globally. What trends are you seeing, and what countries are you seeing the greatest opportunity in growth?
It's a good question. So I think what we see, and we're going to continue and see that there's a growing gap between how tangible an asset really is and the ability to lend capital against these assets. And I think this is exactly the gap where banks struggle, and that's the source of the strength of private credit, right? Because if the underlying asset is not tangible, it's very hard to know what the risk level at any given point. And this is where opportunistic asset managers can step in. And this is a growing market because when you look at the market today, most of the assets are intangible, right? IP of technology companies. How do you estimate the value of this asset? This asset can worth billion today and zero tomorrow, right? So all these different areas where the assets are not tangible enough and volatile, this is where the big opportunity for the future growth of private credit in our perspective. It's a global trend, but we see a lot of growth focus around, of course, MENA region. We have a big office here because of that. We deploy in the region, but also across all APAC and EMEA. We see more of a red ocean type of market in the US right now, and we think it's going to get just more bloodier over time. So, yeah.
Okay. And Lawrence, with this growth that we're seeing globally of private credit, what risks do you see emerging in the market, and how are you guys positioning yourselves in that regard?
Well, I'll give a little bit of a counterintuitive answer. I think one of the biggest risks in the market are the investors. And our investors, not our investors necessarily, but the whole private market world, when you start looking at an asset class like private credit and saying, well, I can get a higher interest rate, that's dangerous because really as an investor, you want to think about what is your net return after credit loss is going to be, not just this quarter, not just this year, but over, it's an illiquid asset class, over the cycles. We went through in 1998, the Asia crisis, 2000, 2001, the internet telecom bust, the great financial crisis, COVID. It's not good enough to earn great returns in the easy years. You lose all your money on the outliers in the bad years. So alignment of interest, focusing on net returns, not gross returns, thinking about, and there are many different good strategies, but if your asset manager is publicly held and has a quarterly conference call and the CEO talks about how much their fee-paying assets under management have grown, you know what their priorities are. For us, you've asked what we do, we focus on our net returns. We focus on being premium return across the cycle. Great.
And just as we wrap up, just a question for each of you, briefly, quick answers. We've seen a really large amount of increase in RFPs this year from the sovereign funds, in particular in the space. What's one piece of advice you'd have to investors, particularly new investors entering this space? I'll start with you, Borja.
So the way we think about credit, and I guess most of us do it the same way, is implicitly that you can have limited upside, but a lot of downside. So I would encourage, as Lawrence said before, to look really into the downside of events that you are not thinking that may happen, but could happen. And for that, either a very diversified pool of assets, or as we like a lot, hard assets, because at the end of the day, the hard asset has an intrinsic value unless you're lending to something that really doesn't have value. It's a strategy that we do like for those black swan events that may come and we're not counting on them or we don't predict them.
Great.
Don't make the loan if you can't do the workout. And if you're going to be an investor, figure out how the manager handles workouts, what their track record is. And if they can't answer the question of how they did workouts 2 recessions ago, pick somebody else.
Right. Yep.
Well, private credit became a very big definition. We are talking about a $2 trillion market, but these credits are not looking the same. Some of them are really large, competing with the broadly syndicated market. The covenants in that area are weakening, the maintenance covenants, etc. The bigger the loan, the bigger the demand, and the bigger the competition. Lawrence has been there before this area was called private credit. He's one of the godfathers of middle market lending, actually. I do think the origins of this business, where it was focused on middle market size companies, is healthy, underwriting is strong. The bigger the loan, I'm not sure if you're getting paid extra for the risk you take. It's very close to broadly syndicated.
Great. And you, Ron?
For me, it's mainly 2 main points. One is make sure you really understand the risk reward you are acting in. And if the risk change, the price needs to change and vice versa. And second, enforcement. Make sure you can enforce the agreement. If you cannot enforce the agreement, don't lend the capital.
Some great advice. Thank you so much, panelists, for sharing your insights on why private credit continues to thrive. It's clear from your responses that there's much to think about, and it's helpful to have people that specialize in this area to give us insights on it. So thank you for joining us, and all the best.